and welcome to Trading the Trend. My name is James Boyd. We welcome you here today. We got Cameron May in the chat. We welcome him and all of you here today. We got Dean, looks like coming in from Dallas. Yeah, Dallas having a little, snow slush. Didn't look too nice on the Twitter I just saw just a couple moments ago. Hello, Don. Life in the Fast Lane. Ray, representing from Europe, let's just say. Elena, Bill, and many others. Welcome to all. Bill coming in from Siberia. Okay. And just real quick as we get started, remember our examples here today will be stock and option based. Also remember when we talk about options, or if we bring up an option example or past example, remember options carry a high level risk, not suitable for all investors. The information provided here is for general informational purposes only. This webcast discusses technical analysis. There's other approaches, such as fundamental analysis. Some might view that to be more superior, okay? We're not going to make that comment, but some kind of view that, or vice versa. Okay, a little fun there between the fundamentalists and the technicians. Those may assert some different views from time to time, as I will bring up here today. Schwab does not recommend the use of technical analysis as a sole means of research. We like to kind of use maybe the combination of the two. Remember that investing involves risk, including loss of principal. And also when we talk about, if we bring up an example of a short option, we're talking about American style options, which just means those can be assigned, okay, at any time to the expiration, regardless of the in-the-money amount. And also we will reference the option Greeks, which measure a sensitivity to something, as you can see there. Now, in our agenda here today I want to talk a little bit about more range-bound type of trading, or strategies that are kind of more potentially conducive to more neutral ranges or sideways ranges, or trends that are going more sideways. Now, before I do that, I want to kind of just give us a quick update. If you have not followed us or realized, so you can find us on schwab.com, or if you just go to YouTube, type in Trader Talks Schwab Coaching Webcast, you'll come to this page. If you've not subscribed yet, you'll probably see right in the middle of your page, subscribe. That way you can follow all of our content, 99% of it outside ETFs, that are posted right here on YouTube. Now, number two, we do have a link for this class, okay? Now, kind of give you a little sense, little flavor of what we've talked about, okay? So if you bookmark this link, you don't have to go out and re-find it again, bookmark it, okay? Last week we talked about sound the alarm, bears taking control. Kind of question that, right? Defending bullish positions in market sell-offs 2 weeks ago, okay? Hard time with potential exits. Watch this. And investor sentiment about the pop. So in the last kind of 4 weeks, if you kind of look at the flavor of things we've kind of talked about exits, maybe sentiment changing a little bit. Wonder if things go down and you want to protect bullish positions, or you have bullish positions, how do you protect them? And then also maybe kind of more bearish trends in some examples. Now, I am not going to talk about bearish trends nonstop, okay? But I think it is appropriate to at least understand some things are not bullish, okay? Now, you could also follow, last but not least, you can follow myself on X, okay? And also, to give you an idea, I typically post probably 30 or 40 times a week. In the last 4.5 years, I've posted about 20,000 times, okay? So I want to kind of give you an idea of, go to my page, see a little flavor of what I kind of post on there. Check that out. And I also do post schedule updates as well, like this week as I'm teaching a little bit more. Also, you can follow Cameron May on X as well. There's his page right there. So I just want to kind of make sure that you have some of that content that we're going to be using here today, okay? And resources. Now, let's kind of start with, just real quick, I want to start just briefly with futures. We're not trading futures, but the futures kind of give us an idea of where we might go to look, okay? I kind of think of futures higher than indexes. Couple things that we're watching here, okay? Natural gas, which we talked about energy, maybe 10 days ago-ish or so. Natural gas kind of still watching to see if that can't break out. That would be related to utilities. It would also be related to energy sectors, okay? So we're going to keep an eye on that. It has not broken out yet on nat gas, but kind of getting to the right edge. U.S. dollar. We got the non-farm payroll coming out tomorrow morning. The U.S. dollar did not close at the brand new high, but pretty close. Euro near lows. British pound near lows, Canadian dollar near lows, Swiss franc near lows, okay? So if you're an American, if you have US dollars, your dollar might go farther, okay? So that's not necessarily a bad thing. Now, so keep an eye on that. So our interest rates, the economic data that we've had in the US has been stronger on a majority basis relative to the other economies in the world, okay? Especially China. Now, if we bring up crude oil for just a sec, this is related to energy. We have not been able to get above the 75, keyword is yet, and you're going to kind of see more of a bearish engulfing here today in that space. Now, how does that relate to stocks? Well, if energy stocks, they're selling crude oil, want to kind of watch and see what the price does. It can affect their sales and or profitability that they actually might get. Now, the area that we're going to watch that I kind of think has been interesting, haven't talked about it, is copper, okay? And if you take a look at copper, that's also had something kind of like a downward slope. Now, how does this relate to stocks? Well, we're talking about base materials. And what stocks in the base materials might get a little bump from copper prices going up? And then if you think, oh, the copper's going up, what is gold doing? Well, let's pull it up, okay? And if you take a look at what does this have to do with stocks? Well, we're talking about base materials again, precious metals, and which companies have exposure to or sell gold, okay, and or copper. Now is gold, let's say, massively bullish? I think we would probably more say the trend is more sideways. Now, that's kind of the overarching theme of what we're talking about here today is wonder if the trend is not super bullish, super bearish, but it's kind of more sideways. What about a strategy in that type of trend? It doesn't necessarily mean that the investor can't invest in it. They just might say, look, I'm not necessarily thinking this is probably going to make 52-week highs, but it might still hold value as long as we still hold above the support level. Quickly, just real quick on the interest rates going into tomorrow, 10-year did actually punch a brand new high here today. Couldn't imagine if you were going to buy a home right now. 7.2% on the 30-year. I know for some of you people that are a couple years older than I am, you're probably saying, James, it was higher than that. I'm aware, okay? That's a brand new high there, okay, for the interest rates, which is some ways a little hurtful, okay? And if you look at the Japanese yen, which we call the international VIX, we do not really see fear spreading. Now, with that, you looking at domestic markets, we see the VIX at about 18. Now, if the VIX is about 18, we're probably thinking that the S&P is going to fluctuate 1.5% approximately on a daily basis, okay? So VIX at 18 doesn't necessarily mean, and by the way, it's not falling right now. We see in the last couple of days, the moving averages have been green, okay? Don't like that. We like that on stocks. We just don't like that on volatility, the volatility index. We don't like the price above the moving average levels and so on. So the volatility is kind of increasing a little bit. And if that volatility is increasing, it's probably going to mean that stocks might struggle to go up, and bull flag, okay, and make new highs. You're probably going to see that stocks might be pressured a little bit, and that might mean a little bit more of sideways ranges. Are there any questions with what we talked about, okay? Now, when we pull up these, okay, just real quick on the SPX, talking about kind of the agenda, right? What's the S&P trend? The last 2 or 3 weeks, more sideways, okay? Now, if you look at the NASDAQ, the trend on that, what do we see? A little bit more sideways. Now, I think if I were going to put, let's say, my bearish goggles on and say, what do we see that is a little concerning? I think one thing that we kind of say that's a little concerning is we have not been able to have the MACD go above 0 in a while. Now, why is that of concern? Well, because if you can't get the MACD to go up, the chances that we're going to make some higher highs becomes less and less. And kind of going back to what we talked about let's say 2 weeks ago, defending bullish positions in market sell-offs, potential exits, and so on. This is where we want to make sure we're crystal clear. If you haven't gone to look at those classes, you need to because, well, we want to practice that, right? So we're a little concerned about how come the MACD isn't going up at all, okay? And the longer that we actually do that, the greater the chances become, and I don't take any joy in saying this, the greater the chances become that this double bottom area of 29.14 is probably not the bottom, okay? That means that this might go down even further, which means you might be thinking about more neutral to shorter term bearish type of trades. Do you agree or disagree? Now, this is what makes the market, okay? Now, so the biggest thing is when we look at, let's say also, and by the way, one other one that's kind of getting pressured a little bit more is the Dow Jones, which is in the shorter term descending triangle. And this right here really measures that bottom. So kind of when we look at this, we're kind of thinking maybe the market is maybe neutral at best. And that's important because that's going to now influence what type of strategies that we pick and what we're most likely going to find. So if I said, look, I'm a super bull, I just want to see bull, 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 I'm probably not going to see as many bullish trades based upon what we see in indexes and sectors and VIX, okay? Now, when I look at strategy, let's kind of talk about this just real quick before we look at our first examples, okay? So when we talk about strategy, okay, you know, if we were going to look at a strategy that has a delta of 0, which would be like you could say, I'm just going to be more in cash, okay? Or cash products. You might think like fixed income, okay? Now, I don't see as many setups right now. I'm going to be more in cash. Cash is a position, okay? Now, doesn't necessarily mean that it makes nothing. It just, you know, it's not going to have probably a 10% rate of return, of course, okay? Now, if we went up that scale a little bit, we're kind of thinking about that short put vertical, which we've done a few of. Long call vertical, that typically has a delta 10, okay? So the lower the depth per contract, the lower that the delta is, it's less sensitive to price changes. Now, that's good probably in this current market because we don't see a super strong trend in the marketplace, just being brutally honest. Second, if I went up the scale a little bit, I'm going to put collar. And I'm just going to call it like you're buying the stock, selling the call, and buying the put at the same time. This is really going to give us a delta of 30, okay? Slightly higher, okay? And if we went up a little bit higher, let's say 35, short put vertical, okay? Excuse me, not short, put, I should say. Or I could include SP for short put, 35. Now, this one's a little dangerous because that's the delta maybe initially. That delta could become higher if the price were going to go down. Now, what you're going to notice is if we go out and let's say buy 100 shares of stock, or in other words, 100 delta, you better get the direction right, okay? Now, notice when we pull up our paper money accounts, we have not done a lot of stock positions. We have not done a lot of long synthetics. We have not done a lot of long calls, okay? We have not done a lot of covered calls in this area. Why? It's an easy answer. Because the trends have stunk, okay? There it is. You're waiting for it, right? There it is. Put it on the table. The trends haven't been there. So when the trends are weaker, we're kind of choosing to do strategies that are kind of more lower in delta, and the key word is defined risk. Hallelujah. Okay? Now, sometimes as investors, we want to push stuff. And I want this to happen. I want this to happen. Problem is sometimes you just don't have the market. We need the market to go up. We need stronger sector breadth and market breadth. And we need the VIX to go down. We need broad participation. If we're going to go out and do cover calls, long synthetics, buying shares of stock, I'll label as S, got to see some stronger trends, okay? So sometimes you just say, look, I don't like those market trends. I'm going to go further to the left and do some strategies that have a defined risk, less capital investment, okay? And they're protective in nature. All right, any question? Now, Christian says, and I think this is right, stonky trends. Christian, okay, I was waiting for that. You were right on cue. Now, I want to kind of talk about some of the things. So one of the things that about a month ago or so, we kind of started talking about, geez, maybe this is a strategy. So why do people like a higher delta? Why do investors like a higher delta? Well, duh, right? because if I get the direction right, I could make more. Okay, fine. So the biggest thing is, why do people like short puts? Well, you get an income, you get the credit, and you have an obligation. You can buy the potential stock, but you might keep the credit. Okay, so kind of a little plus and minus there. But the biggest thing is, collar is going to have something similar delta-wise. Now, what's the difference between a collar and a short put? Does anybody know what the difference is? Short put, you sell the put, you're short Vega. You're exposed to volatility expanding. Collar, no, because you bought a put, okay? Now, what I want to do is I want to bring up an example, if you don't mind, and I would like to bring up an example of BAC. Now, BAC has been one of those stocks that if you look at the trend, it's been more bullish than many other stocks out there, okay? Now, here's the thing. When the market is a little bit more volatile, we're trying to be protective of capital, okay? And the biggest thing is just not try to force ideas, okay? Now, what I'm going to do is I want to show the difference between a collar and the difference between a cash secured put. Let me kind of just show you what I mean for just a moment. So let's say you said, James, I'm a stock investor, and I, for example, go in and I want to buy the shares of the stock, and I want to set a stop. Now, there's a little danger to setting a stop sometimes, okay? So I'm going to actually just click on the ask price right there, and now we got stock buy plus 100. Let's just use 100 for the example, okay? You come in and then say first triggers SEQ. You want to now say, I'm going to set a stop, and let's say you said, James, I'm going to set a stop at 44, okay? So what we see in this case is the stock is at 46. You as a stock investor say, hey, I'm going to set a stop at 44. And all is hunky-dory. Or is it? Okay? Now, one of the dangerous things about volatility expanding, okay, Delta is going to state to us, as of right now, the likelihood of the stock going to the stock closing below that strike by a penny. That's one meaning for it, okay? The other meaning is the change in the option price given a change in the stock price, okay? Now, that delta, if I went to probability of touching, now this is going to kind of be crystal clear on why setting stops right now might be maybe risky, okay, compared to maybe buying a put. Well, if we buy the shares of the stock and then we come in and say, yeah, what I'm going to do is I'm going to set a stop at 44. Well, if you set a stop at 44, that price, we can see statistical odds right now of that stock going down and touching the 44 price level. And I'm saying this as if you're a stock investor. So if you said, what is my likelihood in the next 43 days of buying the stock, setting a stop at 44, and then what's the likelihood of getting stomped out? Answer, about 58%. Now, if the market becomes more volatile, you're actually going to have a higher chance probably than that. If you took 10 trades that was just like this, that means at the end of this next 43 days, you probably would not have 10 positions. You'd probably have 4 positions. And the worst part about that is you would have locked in those losses. Man, that was brutal. I know. That's why I'm not going to show examples of buying stock and setting stops. So when the volatility goes up, the chances of getting stomped out become higher. What we're going to do in offset of that is we're going to buy the shares of the stock, okay? So what we're going to do is we're going to come in. Now, I want you to notice something here, okay? Look at how much cash we have relative to the account balance. What is that telling you? James really hasn't invested that much. He's doing kind of the more defined risk trades. Is that on purpose? It's on purpose, okay? Just seeing less stronger trends. Now, I'm going to go to the trade tab. What we're going to do in this case is we're going to click on BAC. We're going to click on the ask price, just like we saw before. So not bad. Now, number 2, if what I'm going to do is I'm going to come down to sell a call and buy a put with a delta of about 30 to 40 on both sides, okay? What we're going to do, single order, okay, right there. we're going to sell a call with the delta 30-40. It's about 48, the strike at 48 with a delta of 37. So now if you take a look at this, now this is what we need to really know. If the stock goes from 46.21 and the stock goes up to 48, does that mean someone takes the shares? No, not necessarily. Okay? They could, and they could even take the shares prior to the stock being at 48, but that means they have to give you up to the 48 regardless, and they have to give you all of the premium. I know, you're thinking, geez, could I volunteer? Now, if we go over here to the put side, we're going to buy the put at, let's say, 45. And I'm going to click on that, and now what you're going to see, and by the way, we don't have to do the 45. Let's even click on, let's say, the 44, okay? Now, if we did this, you're going to see that there is a slight credit here. So why is James kind of hammering these in the last month or so? Well, let's bring this up so we could see this, okay? So when you do a stock position, there's your profit loss diagram, a diagonal line, okay? Second, if we bring up, well, what does the cover call do? Or what does that short call do? It caps the upside, the blue line. And the last but not least, the long put, which is the right to sell. Now, this is important because when you're in more volatile markets, you want to know number one job is not to make money. The number one job is to protect your capital. Okay? So what you're now going to notice is we can see what that defined risk is. It's about $200. All right? There it is. Now, this right here, you're going to see that's the current stock price. And that right there is really your break even at expiration. Okay? Now let's compare, let's kind of look at the option Greeks for just a moment, okay? If we look at the option Greeks on this position has a delta of 36. What does that tell you? Well, remember, when we talk about delta, okay, I'm going to do a little triangle, okay? And I'm going to put that triangle really represents change. The D is for delta. This is the change in, let me kind of put it like this, okay? Let me write it out so there's no confusion, okay? Delta, okay? Delta equals the change in the option, okay, price over the change in the stock price. There's your delta, okay? Now, if we take a look at this, if we have a positive delta, this is a bullish strategy given these three positions, okay? If we look at the theta, is it theta positive or negative? It's slightly positive. So if this trend goes sideways, this position is not going to get hammered based on time decay. No, it's not, okay? Why is that? Well, because you have a little bit more credit coming in than the put debit. Now, wonder if volatility, well, the VIX just shoots way up. Well, the VIX shoots way up, this strategy is more neutral Vega. So this strategy of the four Greeks, delta, gamma, theta, and Vega, you're going to really see that if you take a look at this, the delta is the highest Greek. Now, wonder if all of a sudden, let's go back to gamma for just a second. Let's say that the stock goes up $5, okay? And let's say, for example, the stock goes down $5. How much does the delta change by? Well, let's take a look. Stock goes up $5, the delta goes from 36 to about 17. So the gamma does affect it a little bit, but the position, if the stock goes up, it's still bullish, okay? The stock goes down, it goes down to about 19. It's still bullish. So notice that delta is holding a lot closer together to what it was initially put on as. You cannot say that with a short put. You have movements in the stock price or volatility, it affects the delta and the option premium. That's huge, okay? If you do cash secured puts, the investor is probably going to want to buy a downside put to neutralize, Bill, pay attention, neutralize the Vega. You know how careful I got to be? Okay. All right, Bill knows that joke. Now it's okay. Here we go. What we're going to do is, now, by the way, what do we want the stock to do in this position? What do we want the stock to do if we have a positive delta? Well, the answer is, of course, go up. Okay? Now, we know that if we take a look at this, we can see kind of what's the maximum gain. The maximum gain is about 200. Okay? So this position kind of becomes maximum gain about 200, maximum loss about 100. Okay? Now, what I'm going to go ahead and do in the IRA account, we're going to go confirm and send. So you might do cash secured puts. The paper money account is probably going to do more callers. Why? Well, because number one is I want to make sure that this delta doesn't change very much. As you'll see in just a sec, if this stock goes down, down, down on a cash secured put and you don't have downside protection, you're wishing that you could give back the premium, because now you're starting to have unrealized losses and you're at risk of volatility rising. Be very careful in a rising volatility environment about selling puts, selling calls. It's almost like the investor is getting baited into selling something. Rising volatility environment, you're at risk of volatility going up higher and inflating those option premiums if you were to buy them back, thus neutralizing what you thought you were going to get of time decay. I'm going to go ahead and send that order. Now, let me just do this real quick, just quick comparison. If we came in and said, hey, I'm going to sell this 45 strike, and I'm going to sell the put. That's a bullish trade. What about if we just sold the put? What's the difference? Well, if we come in and just say, sell the put by itself, okay? Now, remember this is going to be ugly here, okay? Want to see the car crash before the car crash. So I want to know what could happen. If the stock, here we are right here at 46.21, the investor comes in and says, yeah, what I'm going to do is sell a put. Yeah, go for it, okay? You sell the put. If the stock goes up, the delta becomes less, meaning that per a $1 move, the investor is not making as much, okay? And then if the stock were going to go down, the delta becomes 82. Whoa, okay? So remember, that delta is the change in the option given the change in the stock price. If the stock goes down $1, if it goes down $5, the delta approximately, given the model, would be at 82. What is that saying? You thought the losses were going to be small, but they're bigger than you thought, okay? Why is that? Gamma's bigger. Gamma is the change in the delta given a $1 change in the stock price. And if you look at kind of the danger of selling the put by itself, the higher the negative vega, the greater sensitivity you have to losing, having unrealized losses if the volatility were going to expand. So as you can tell, we're putting some little red tape, yellow tape, I should say, around selling cash secured puts. Now, how does the investor try to neutralize that? Well, let's bring up the next example, okay? Now, what I want to do is I want to bring up an example, and I want to go towards a stock. Let's say the investor said, James, I'm kind of bullish here, Citi, okay? Citi. And Citi's been quite bullish. I want to be bullish. I want to sell the put, okay? And I want to do more of a cash secured put, but I want to have downside protection, okay? So how can we do that a little bit more responsibly from a maximum loss standpoint, more capital efficiency, but also mindful of the option Greeks? Now, some of you might have thought option geeks. No, it's Greeks, okay? Now, what I'm going to go ahead and do is we're going to go back to the trade tab. Now, remember, we wouldn't put any trade on. If we didn't like the setup in the paper money account, it's not a recommendation, wouldn't do the trade. In this case, what we're going to do is we're going to sell the 70. Now, we're going 20 to 50 days to expiration, okay? The 21 February with 43 days left, kind of in the middle there. We're going to sell the 70s. Number two, if we wanted to be a little bit more careful about stock trend going the wrong direction or the volatility spiking, okay? Now, by the way, that's kind of like if the volatility goes up, doesn't that normally mean the stock price could go down? And that's the answer is probably true. That's true. Not always, okay? Sometimes you can see the stock just go up like a lot and the volatility is going up. That's not as common though, okay? Could happen, but not as common. Step one, we're going to sell the 70. And what we're going to do is we're going to buy a put below with a delta of about 10 or less. Now, what you're going to notice is in one hand, we're trying to collect that $1.37. In the other hand, we're saying, look, I want to know that there's a defined risk. I want to know that also I'm more neutral on Vega. Now, remember, if you sell something, you have negative Vega. You have risk if the volatility were to expand. You'd like volatility to fall. If you buy a put, you're long volatility, and you like it if volatility rises, okay? And you tend to lose, or you do lose if volatility were to contract, okay, on that long put. Now, just the opposite of each other. Let's bring this up and kind of show what this looks like. So now what you're going to notice is, in this case, if we did this position, what is the delta? The delta of 22. So it's not as bullish as the cash secured put. Now, wait. Wonder if we go down to the 60. What does that do? Well, it's going to make the delta a little bit bigger. So when you widen those strikes out, it makes the delta bigger, okay? There you go. And then if we went back to what we had, just to kind of show what we had before, you're going to notice that the Vega is not as negative. It's still negative, but it's not as negative. Now, what you're going to now notice is if the stock goes down, instead of it being a delta of, let's say, 89, like we saw before in the previous example, it's a delta of 41. Why does that matter? Well, because when things are going down, the lower the delta, that means you have less sensitivity to the price movement. You ever been in a situation where the stock is going down and you said, I wish I didn't have as many shares as I have? Because you had a greater sensitivity. With a lower delta, you have less sensitivity to price change on the stock. Okay? Now, what we're going to do in this case is we're going to go to C. We're going to sell the 70 and then buy the 62.5. Okay? Now, I want to kind of go now to questions. So the first thing we talk about, and guys and gals, this is very important because sometimes when we have a situation where volatility is expanding, investors could just continue to pick stock positions or covered calls or long calls. Be careful on that, right? The question is, do you have a trend for those type of strategies? To have those type of strategies done, the investor's probably saying, I need markets to be above their 10 and 20 period moving averages. We need volatility to go down. We need kind of more participation in sectors, not just maybe one or two, but others. And if you look at the sectors, that is not what we see right now. Yeah, but James, tell me what I want to hear. I'm a coach. I don't tell you what you want to hear. I tell you what you need to hear, okay? And now what I'm going to do is confirm and send, and we're going to send that, okay? Now, are there any questions? Now, if we take a look at this, now, Jack, I'm not sure how you set that up. Let me show you how we set that up, okay? Now, I want to go just real quick to a different example, and I'm going to go back to GE for just a moment, okay? Now, I'm going to take the exact same trade that we did strategy-wise, okay? Now, we've been kind of looking at GE. There's a couple versions of GE, but if I go to the trade tab to kind of do what we just did, if I go down to the 165, right-click on that, okay, bid, sell, and then vertical. That's what we did there, okay? Now, if I tried to get this to go, that is your classic vertical. If I widen the spreads out there, 165, 155, it's still vertical, okay? So, Jack, the question would be is, when you put this in, can you practice just doing a vertical? You can change the strike. If I go to confirm and send, I shouldn't get pushback on that, given that it's a vertical, okay? I think that might be smoother. If you clicked on sell the bid, then first triggers SEQ, then buy, you might not even have to do that. Just do a classic vertical and change the spread in the paper money account, okay? Other questions that you might have, okay? All right. Now, any other question? Now, the question is time decay is for the holiday. Well, time decay, it's a model, okay? So if we have the market closed like we do for the Jimmy Carter observance, that time decay theoretically should be taken out. Now, I have always wondered, is there a certain time of the day where the time decay is taken out? Or is it just kind of taking it out gradually throughout the day? I've asked market makers this question. Never gotten a real definite answer. I've even kind of watched, okay, the option prices to kind of see maybe where that time decay might be extracted. When I kind of noticed that there was a little slippage, it kind of seemed like 1 hour before the market closed. Now, I used to think that if someone sold puts on Friday, on Monday, all you'd have to do is come back in the market on Monday. And then if someone sold 10 contracts, maybe some decent theta, on Monday morning, assuming that the stock is at the same price, volatility is the same, there should be some free money on Monday morning. To much of my dismay, there wasn't any free money. So it seems like the time decay is extracted before, okay? I have not seen that, oh, the next day it just dropped, given the stock price and the volatility is the same. So keep an eye on that. Do you notice that maybe in the last hour or so, even when the prices are flat and volatility is flat, that there's a little decay on those options? Keep an eye on that, okay? Now, the other one I want to kind of go back to for just a sec. So Jack says, it says, I cannot create a custom spread. We don't need a custom spread, okay? If we just right click on that, sell, and then go to vertical, okay? What you're now going to see is in the spread, it says vertical. If you click this and yours says custom, you're doing it different than what we're showing. And so if I did custom, that's where you're kind of changing things. We're not doing that. We're just saying vertical. Right click, sell, vertical. Okay? So it's no different. If I came in here, calendar, I should see calendar. Okay? Right click on that right there and go to where it says butterfly, whatever it is. Whatever strategy I pick, that strategy I pick should be in the first column underneath spread. Okay? Now, let's kind of go back to just real quick. And I just did that G as far as a little quick kind of view. Now, I do want to go back to one that I do want to do a paper trade on, which is ConocoPhillips. Okay? Now, there's a lot of us. How many of you are directional traders? How many of you just like to get the direction right? How many of you are like people that you like to just be right and say, see, I told you so? Now, I think that's many people. I think a lot of us like to be right, okay? Now, one of the stocks that's, trying to get a little push here is ConocoPhillips, okay? Now, remember, if crude oil goes to the upside, where might ConocoPhillips maybe go? Now, one of the things I've been looking at fundamentally, and I'll bring this up, I'm kind of interested on not what some of the PEs are on the charts. I'm kind of interested on like forward PEs, okay? So if you look at a PE ratio, they're looking at price over the last 4 quarters of earnings per share. The forward PE is really looking at, let's say, the current stock price. And what you're now going to see is, by the way, when you log into Schwab, you're going to see that also it gives a little notification. And this is a great reference, but you have to sign in. And it's going to show you the differences in between different types of products and their market hours for U.S. and Canadians. Okay, now, what I'm now going to do is I'm going to pull this up, and I want to type in COP for just a second. Now, in the current marketplace, if you're an income investor, if you're a value-based investor, if you think technically things might be a little oversold and could snap back, now, by the way, which are some of those stocks that might kind of be in that category? ConocoPhillips, CL, Colgate. Another one is MO, and another one is Mondelez. Okay. Now, if I pull up COP, okay, the one thing I want to really do, and I want to grab out of this is, I want to pull up COP and just look at, just real quick, the forward, if I can. There you go. And I'm going to scroll down to what the PE is, and we can see the PE right there, okay? So when we look at the price to earnings, okay, the price, as the price has gone down, and maybe the earnings per share stay what it is, that PE is only 12, okay? The forward PE, okay, is literally sitting at 13. We cannot say that everything in the market is expensive, okay? That is a very low PE, okay? And energy stocks don't typically sell for high PEs a majority of the time, well, because there's a lot of volatility in the oil price. Now, what I am going to do, and I'm going to do this from a stock perspective, okay? We are, number one, going to buy the shares of the stock here. Now, watch what we do, okay? I'm just going to go to the trade tab, and I'm going to buy the shares of the stock. Now, I already went over the demonstration. What if you were to buy the stock and then set a stop? You think you're fine, but you got to recognize if you're in a higher volatility environment, the chances of getting stomped out are probably going to be about 2 times the delta. Okay? So if I said, hey, I'm going to buy the stock at 101, set a stop at 97.5, probably about a 60% chance of getting stomped out and potentially locking in those losses. We're not going to go there, okay? In this example, we're going to go to advanced order, single order. We're going to go to where it says first triggers SEQ. Now, what we're going to do here is we're going to say, look, instead of setting a stop, the right to the trigger to sell, we're going to buy a put. Now, why don't people buy puts? Well, they got to pay for them. Why aren't you paying for the stock? You sure are, okay? Now, what you're now going to notice is if we buy shares of stock, what do you want the stock to do? Of course, go up. And if you buy the put, this is the right to sell the stock at 97.5 from now until the 21st of February, okay? Now, what's the bad side about this? You got to pay $2. That $2 theoretically adds to what you bought the stock for. Now, if we put this right on the Analyze tab, we're going to see these numbers. We'll see what that break even is, okay? And what you're now going to notice is when you pull this up, here's where the stock is now. This really represents where the stock needs to be at the expiration, okay? So what you're now going to notice is this is where the stock is now. This is where we need it to be just to break even at expiration. The stock price add the price for the put. Anything above that 103.73, 103.74 and change, anything to the right is upside profit. But what you're going to notice is that if the stock goes down, a defined risk. And if that stock goes lower than that, this gives us the right to sell those shares at that strike from now until expiration. Notice I've said the word defined risk probably 10 times here today. You know, in a more volatile environment, defined risk is maybe the investor's friend. Using long puts or callers in maybe a substitute to setting stop for some that would consider that might be something to consider. Now, what we're going to do in this case is we're going to confirm and send. This is, you could think of this as a married put. We buying the shares and buying the put. We're holding that put typically all the way to expiration or to expiration. Con about that is we need the stock to go up to that break even or higher, about 103.74. Now, here's the deal. If volatility were to go up, that's not necessarily bad for that position. It's Vega positive. And the last thing as we wrap up here is if the stock were going to go down to 97.5, that does not mean we're out of the position. We still have a right to sell it. And so we're trying to absorb volatility without triggering and realizing the losses like a stock investor would. So that's going to be something that we want to practice here. Note the commission, send the order. Your homework assignment is to go out and practice a caller position, and I want you to practice a married put position, okay? Both are stock-based, but you're using options as a way to kind of change the deltas and the Vega and try to control for price risk, volatility, and volatility. That's your homework assignment. Now, also, I want to give us a quick reminder that coming up next, as we go to the calendar here, well, won't pull that up here, okay? So if we came to the next, you're going to see that if we reload right here, you're going to see the next class coming up right at the top of the hour. Make sure that you subscribe to the Trader Talks Schwab Coaching webcast. That way you can see all of our classes. Now also remember that this class has been recorded, so you can go back and watch these other sessions that I've done for this class and also Cam's classes as well. Now, I also want to kind of make mention that I gave you a homework assignment. Go out and practice. Feel free to practice the ones that we did, so that way you can follow along as well. Now, remember with what we discussed, it was done for example, illustrative purposes only. And remember that all investing involves risk. And this has been the class really on trading the trend, but more in a neutral fashion. Not necessarily up or down, slightly bullish, but defined risk for a certain period of time to expiration. With that said, stay tuned for our next webcast coming up at the top of the hour. I'll be back at 4 p.m. Eastern. Take care. Bye-bye.